Moving on, let's put the spotlight on the economic impact on households of the war. And the surge in global fuel prices is hitting U.S. households unevenly. According to the Federal Reserve Bank of New York, lower-income households are bearing the brunt of the shock. As gasoline prices climbed sharply, wealthier households were able to increase spending and maintain their fuel consumption levels. In contrast, low-income households saw their spendings rise, were forced to cut back on actual fuel usage. Now, this suggests a shift in behavior, from reduced travel to increased reliance on carpooling or public transport. The data highlights a widening consumption gap, with the impact now even more pronounced than during the 2022 energy shock following the Russia-Ukraine war. The New York Fed's Global Supply Chain Pressure Index jumped to 1.82 in April, its highest level since mid-2022, and the steepest monthly rise since the pandemic that began in 2020. The disruption is being driven by conflict-linked bottlenecks. As a result, energy prices have surged, with gasoline seeing its fastest rise in over 30 years, while diesel prices have climbed even faster. These pressures are now feeding directly into inflation. The inflation spike is complicating the Federal Reserve's policy path. Hopes of rate cuts are fading, with policymakers now signaling a longer period of steady or even higher interest rates if price pressures persist. Projections suggest inflation could remain close to 3% by the end of the year, with additional pressure coming from tariffs, energy costs, and supply chain disruptions. For markets, this poses a significant risk. Without the cushion of rate cuts and with inflation resurging, the current energy shock could evolve into a broader economic and market challenge in the months ahead.